Welcome students. Today I would like to welcome you to my discussion on what is comprehensive income. If you're like most students, this is kind of a confusing and somewhat abstract notion at this point, and I hope to move us forward on that today in our discussion. Comprehensive income is changes in shareholders' equity other than those that come about from investment by owners or distributions to owners. So it's any change in shareholders' equity that does not come from those sources. Let's consider the balance sheet equation. Assets equals liabilities plus shareholders' equity. If you grouped all the shareholders' equity accounts together and considered those the beginning balance, they would go up for investments by shareholders in whatever form they made, and that total would go down by distributions to shareholders. Usually that would be an issue of common stock for an increase and a dividend for a decrease. These items are not part of comprehensive income. How else does shareholders' equity change? Well, it goes up for net income, and net income doesn't come about from an investment by owners or distribution to them, so that would be part of comprehensive income. And it could also go up or down for other items of comprehensive income other than those that are traditionally associated with net income. So it has a beginning balance. It goes up for investments, down for distributions, up for net income, of course down for a net loss, and it can go up or down for other items of comprehensive income. When all of those are summed together, that would come up with the ending balance in stockholders' equity. Let's have an example of comprehensive income. You learned about available for sale investments in previous accounting courses, and you learned that available for sale investments were written up or down to their market value on the balance sheet date. If the fair value of that investment went up on the balance sheet date, you would debit an account called fair value adjustment, and you would credit an account called unrealized gain. Because it was an available for sale adjustment, that was not allowed to be included as part of net income. It had to be included in a separate component of stockholders' equity. Consider the effects of that on the balance sheet equation. Assets would go up, and if you're going to stay in balance, then something else needed to go up. And it couldn't go into net income because it was an available for sale investment, so it was included in an account called comprehensive income. In that way, you were able to increase the fair value of the assets and increase shareholders' equity, but not include it in net income. Both net income and these items of comprehensive income come together to equal the total of comprehensive income. You might be wondering, what else goes into comprehensive income? Comprehensive income currently has 4 components. It has unrealized gains and losses from available for sale investments, foreign currency translation adjustments, gains and losses from certain post-retirement benefit plans, and deferred gains and losses from certain derivative transactions. That's it at this point in time. There are only 4 components of comprehensive income. The one that you'll be most concerned with in intermediate accounting is unrealized gains and losses. So then, how do we report comprehensive income, you might be asking yourself. One way to report it, and there are 2, is to show it in a single continuous statement where you take revenues minus expenses and compute net income in the common way that you've always computed net income, and then increase or decrease that for the 4 comprehensive income items to come up with comprehensive income. And in this fashion, you have one single statement that shows net income and comprehensive income on it. That's one choice. And the second second way is to create separate two separate statements. So you do your regular income statement where you'd say revenue minus expenses equals net income, and then you would do your comprehensive income statement. The comprehensive income statement would start with net income because it is a component of comprehensive income, and then it would adjust it for other comprehensive income statement items, and it would come up with just comprehensive income. Either way, you can see that net income is included in comprehensive income. In our first example, some people say they like it better because comprehensive income is just as important as a traditional net income. People that are opposed to that take the opposite position and say it merely confuses the reader and you're actually computing things into net income that you had agreed to not put in net income. Proponents of the two separate statement methods would say it's much clearer. You can see net income by itself and then adjust it for comprehensive income, and thereby the readers can see pure net income and comprehensive income. People that don't like the second method say comprehensive income is really just as important as regular net income, and it should be shown giving as much emphasis. Regardless of which camp you belong in, generally accepted accounting principles now require that you show regular net income and comprehensive income to your readers. So, there's a brief description of what comprehensive income is, the four things that are contained in it, and the two ways that you can show it on the financial statements. Thanks for joining me for this brief discussion.